Here we are to talk about the indirect method, and I'm only going to spend just a brief moment on this. This is sort of a conceptual slide that will probably not make a lot of sense, and I think it probably makes more sense to sort of dig in and start looking at this. But essentially what we're doing is we are adjusting net income for the changes in cash. And the first place you want to start when using the indirect method is with the income statement. Here is our Rundell Inc. income statement for the year ending 2008. We're just going to hop down here and note the net income. We're then going to get our hands on our comparative balance sheet. So when we talk about comparative, we're comparing one year to another. Pay particular attention because there is no prescribed way that this happens to be year 2 in the first column, year 1 in the second column. Those could very easily be flip-flopped. So when you're approaching a problem, make sure that you are getting the difference between year 1 and year 2, and when you're subtracting, you're not inadvertently mistaking year 1 for year 2 because you got used to seeing 1 in one column and now they give you a problem where they're not in the same place. So we'll start with looking at our cash. We had an increase in cash between year 1 and year 2. And this is, remember, this is effectively the end of year 1. This is the end of year 2. So the difference is what occurred during year 2. Note that 71,500, that will be important later. We go down the list of assets and we note the change between year 1 and year 2. If it is positive, then we just put the number down. If it is a reduction, a decrease, then we indicate that it's with parentheses as a minus. So we go on down. Now notice that our accumulated depreciation actually goes up from year 1 to year 2, but we have that as a deduction. And the reason is because accumulated depreciation is a contra asset account. So it's going to appear opposite in the asset section. Debits and credits are going to be treated opposite for a contra asset account as the rest of the assets are. Now we move down to liabilities. And again, it's just the same thing. We're just taking the difference between year 1 and year 2. If it is a deduction, then we're going to, sorry, I had to cough. If it's a deduction, we're going to have to subtract it. Any additions, we just put in there without parentheses, and on down the line. Okay, so now what do we do that we've done that? As I said, we've got the income, net income of 108,000. We also need to calculate what we paid out in dividends. Now remember, we had an $80,000 change in our retained earnings. If we had net income of 108,000. If we had a change in retained earnings, because remember, we close out net income goes into retained earnings. So if our change in retained earnings was 108,000, we know that we didn't take any money out, we paid no dividend. But in this case, the change in retained earnings is 80,000. So what we know is the difference between the change in retained earnings and what it would have been if we'd paid no dividend out is what we paid in a dividend. So $28,000 is what we paid in a dividend, and we're going to note that for our financing section a little bit later. So conceptually, what we're doing here is we're taking that 108,000 in net income, and that was earned on an accrual basis, and we're basically going to convert that to the cash basis to figure out what the actual inflows and outflows were. And we're going to do this in a number of steps. The first thing that we want to do is we want to look at the depreciation that we took on our fixed assets. Now, we subtracted depreciation on the income statement in order to get to our net income. But if we want to work our way back to what a cash basis would be, that's a non-cash activity depreciation is. So we're going to add back in our depreciation expense. Similarly, any amortization on intangibles as well. Gains and losses, depending on what it is, either get added or subtracted. Now this is just the gain or the loss, not the entire proceeds from the sale of something. So we're only looking at the part that is either a gain or a loss. If it's a loss, we're going to add that back in. If it's a gain, we're going to subtract it out from our net income. We then get to look at the changes. When we looked at our balance sheet, we went down that column and we did the pluses and minuses all the way down. This is where we now use those numbers. So we ignore the cash. We're going to use that at the bottom later. So we're going to start with accounts receivable. And we're going to, if an asset, and this is probably the easiest way to do this rather than having me walk you through this slide. If an asset increases, that's going to get subtracted. If an asset decreases, you're going to add that. When we come to liabilities, it's the opposite. When a liability increases, that gets added, and it's going to, so we're going to, liabilities will follow what would be a more intuitive flow. If a liability increases, we're going to add that amount of the increase. If a liability decreases, we're going to subtract that. So once again, assets are treated opposite of liabilities. If a liability goes up, it's a subtraction. If a liability goes down, we add that back in. So we go down our balance sheet and we take all of the pluses and minuses from the assets and the liabilities. And this gives us a net cash flow from operating activities. So just to recap, we start with net income. We first make adjustments for any non-cash items, depreciation and amortization, gains or losses. Then we go right down that balance sheet, skipping over cash, but looking at accounts receivable, inventory, all of those things right down the line. If it's an increase in an asset, we deduct it. If it's a decrease in an asset, we add it. Opposite for liabilities. I know, it's unpleasant. And this just says, so here are the numbers version of the example that we're working with. We've got our net income. We had $7,000 in depreciation. We added that back in. We had a gain on the sale of land. We subtract that. Then we get to all our balance sheet items. And all you're doing is just plugging those in here for, again, and I will promise not to repeat this more than just this last time. If an asset increases, we subtract it. So our accounts receivable had gone up by $9,000. We're going to subtract that. Our inventory went down by $8,000. So we're adding that back in. We're now here at our liabilities, accounts payable, accrued expenses, and decrease in income taxes. And the signs, whether we add or subtract, will follow a more intuitive whether it's increased or decreased. And that gets us to our net cash flow from operating activities. And so what do we do with this number? We're going to just tuck that aside for a minute. Now, the next several slides, oh, I pray that it's not actually the 16 that it says here, walk you through the explanation that I just gave. Rather than reading those slides to you, I'm just going to slowly scroll through those slides. If you want to pause this, read those more slowly, but it's just a recap of what I walked you through on that statement of cash flows a second ago. Okay, and we've got a little checkup corner here. Whoops. Okay. So I'm going to actually stop this video here and go on to the next one for investing activities.